right now, there's a lot of global capital stuffed into U.S. equity markets. It's not really been like this since around the dot-com bubble. And if you do start to get rate cuts, you could get foreign equity holders pulling out from the U.S. market. We're setting up at least a potential for significant capital rotations out of large cap U.S. low volatility equities and into other parts of the U.S. market, as well as other parts of the global market. Should the Fed even have a mandate? You can chalk it up to maliciousness, you can chalk it up to incompetence, but there are serious issues with the data, and I would say with the entire model of a centrally governed interest rate to begin with. Currently, my base case is bullish on Bitcoin over the next 18 months.
How bullish?
On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
Hello, I'm Michelle Makori. Thank you again for joining us. We are about 3 weeks away now from the Federal Reserve's monetary policy meeting on September 18th. And we've recently seen that the labor market is not as robust as it seemed. In a significant development, the Bureau of Labor Statistics has revised down the total number of jobs created over the 12 months ending in March by a staggering 818,000. Now, this revision represents the largest downward adjustment since 2009. And following this major revision, Federal Reserve Chair Jerome Powell delivered a highly anticipated speech at the Jackson Hole Summit, signaling that a rate cut is the next move, stating the time has come for policy to adjust. The markets are fully expecting a rate cut in September, with the CME Fed Watch tool showing a 100% chance of that. The only debate amongst investors is whether the cut will be 25 basis points or 50, and about 65% of investors are leaning towards the smaller cut of 25 basis points. My next guest, however, believes that these rate cuts by the Fed will ultimately only have a limited impact on the U.S. economy, that the U.S. economy will likely be desensitized to interest rate cuts in the next business cycle, and that interest rate cuts could set off a significant shift of capital outside of the U.S. and into other markets. Joining us now to discuss what's really happening with the U.S. economy and what the upcoming rate cuts could mean for U.S. stocks, gold, Bitcoin, and emerging markets is Lyn Alden. Lyn is the founder of a Lyn Alden Investment Strategy and the author of the best-selling book, Broken Money. She's an independent analyst who's known for her institutional-level research, explained in plain English. And Lyn also serves as an independent director on the board of Swan and is a general partner at the venture capital firm Ego Death Capital. And of course, she's a fan favorite here on Kitco. So nice to see you again, Lyn. Welcome back.
Happy to be back. It's been a while.
All right, Lyn, I know that big picture, you think that a rate cut cycle is coming, but that ultimately the U.S. economy is somewhat desensitized to that. I do want to get into that in more detail. But before we do, I want to keep it to the near term. And let's start off with what you expect from the Fed at the next meeting. Speaking at Jackson Hole, Powell indicated that his focus with regards to the dual mandate is now more on the jobs angle and less so on the inflation angle. Let's take a listen to what he had to say.
It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
So, Lyn, before we get into your bigger picture outlook here, where you see the U.S. economy ultimately being desensitized to rate cuts, let's focus a little bit on the near term first. And what do you expect from the Fed at the September meeting?
So I think that market consensus is pretty accurate. My base case would be 25 basis points, wouldn't be shocked by 50 basis points. And what the Fed tends to do is they tend to send speakers out with the statements that kind of shift the market's perception that, if the market was over expecting 50 basis points while the Fed was expecting probably 25 basis points, they'd probably start sending out some slightly hawkish speakers, and vice versa. If the market wasn't expecting 50 and they were intending to do 50, they probably would start sending out more dovish speakers. So for these near-term cuts, I would expect, that the market pricing is fairly accurate. I think we're going to see a mild set of cuts coming up.
All right. Now, it's interesting, Lyn, because it seemed to get a more definitive message from the Fed after that labor market revision, which was very significant. I mean, what do you make of the fact that we had a major jobs number revision wrong by over 800,000 jobs? As I mentioned at the top of the show, the Bureau of Labor Statistics revised down the total number of jobs created over the 12 months ending in March by 818,000. It's the largest downward revision since 2009. And it seemed like Powell was really emphasizing the labor market part of the dual mandate, the unemployment and employment aspect, much more than inflation in this speech, setting himself up for the rate cut. Well, firstly, I mean, this is the data that the Fed looks at when making decisions. So it's clearly a little disconcerting, to put it mildly, that it's off by such a huge number. What do you make of this revision?
So there's been a number of analysts, including myself, that have noticed that for the past 2+ years, there's been a big gap between the household survey and the payroll survey. Basically, if you ask people what is their job situation, and if you ask businesses what is the job situation, there's been a wider than normal gap between them. One of them counts basically people that have multiple jobs, the other one doesn't, different sources of reporting, and they showed bigger than normal divergence. And that can be chalked up for a number of reasons. The post-pandemic economy is a little bit structurally different. There's more work from home, there's more gig work, there's more piecing together multiple types of income sources. It's also not always clear the immigration numbers in a given year and how that can impact job markets around the margins. And so I think that those factors added more uncertainty than normal compared to what they had, kind of prior to 2020. So this is not like a big shocker in many ways. It kind of brought down the top level estimate down to somewhere kind of in the middle between those two estimates, and shows that the economy was softer than was expected. Even before the revision, the official unemployment rate had risen from 3.4% to 4.3%. And historically, when the unemployment rate rises by that much, it doesn't usually stop. It usually keeps going into a recession. It doesn't mean it has to happen every time, but the Fed is very aware of that historical trend, which is why they're not really fine with further softening in the labor market. If you look at their projections, they tend to project what they think unemployment is going to be, a year by the end of the year, by the end of next year. And this kind of rapid increase to 4.3 already hit kind of at or above their median expectations, even looking out to next year, the end of next year. And so the fact that it's now at the high end of their expectations kind of shows that their mandate is shifting. And one could back up and say, should the Fed even have a mandate? Like, we generally don't think that price controls are a good thing. Should they control the price of money, right? So there's kind of philosophical discussions around what the central bank should even do. But given what he's officially mandated to do, which is balance unemployment with inflation, and there's other shadow parts of the mandate. They call it a dual mandate, but also maintaining stable long-term interest rates is part of the mandate as well as unofficially maintaining financial stability. So as he kind of balances them all together, he's more concerned, or at least equally concerned, with the unemployment rate continuing to rise compared to inflation not necessarily falling down to the target as fast as they'd like to. So they're kind of stuck, on kind of both sides of the mandate at the same time.
Well, Lyn, the Fed is supposed to be apolitical. And should this cut happen in September, I think the general expectation is for the markets to rally on that. Firstly, before we get into the political implications, again, near term, I know we'll get into your long-term outlook, but near term, what would you expect as a response from the equity markets on the rate cut that we would get in September?
I think it mostly comes down to whether it's surprising. If we get the 25 basis point cut, the market's already largely priced that in. And long-term rates are well below. I mean, they priced in multiple cuts in the quarters ahead. So I don't think a 25 basis point cut would be particularly substantial. It's possible you get a little bit extra kick out of 50 basis points, at least on current pricing. But a rate cut of that magnitude, I don't think is particularly impactful for either equity markets or the economy as a whole.
Okay, we'll break that down, but it still remains the fact that we'll have a move by the Fed so close to the elections in a very contentious election year. And this has raised some red flags. Ben Shapiro, host of the Ben Shapiro Show, admittedly a very well-known conservative and Republican, he posted on X last week, reacting to the jobs revisions, that this is amazing for two reasons. One, they've been lying for a year about the Biden-Harris administration job creation. Two, they're dumping this data just in time to justify a Federal Reserve interest rate decrease for the election. Fed is supposed to be apolitical, as we know, and a major cut could impact that, could be seen as a little boost to the markets. What's your take on these revisions and the potential Fed move in light of what the likes of Ben Shapiro and other conservatives are saying?
Well, so the revisions themselves, they weren't from the Fed. They were from, the executive branch. And so, yeah, there's always a possibility that games are played there. That's not out of the question. The models themselves are flawed in the sense that they have all these assumptions built into them. Like they have a natural kind of guesswork for how many businesses are created or die in a given period. And then they have to kind of go back and revise that retroactively. It's actually fairly common kind of during or shortly before recessions for multiple quarters of data to be revised down because a lot of it is just kind of projecting what's already happening. So this can happen without intent. It's just bad, top-down economic models of a 330 million person economy are kind of in some ways silly to begin with. There's some metrics are actual numbers. Like, for example, jobless claims that come out, those are actually counting what's happening. Whereas these other things are kind of a combination of counting and projecting. And so all those projections are inherently flawed. And then from the Fed's perspective, right? So they're not the ones compiling that information, but then they have to respond to that information. If they were in a position where the data now, at least according to their model, if they're supposed to kind of soften interest rates based on the data at hand, but they don't because there's an election coming up, that actually would be somewhat political. So it's kind of a mix. It's almost like they should, in theory, put blinders on and just operate like basically there's kind of a centralized algorithm that they're supposed to operate. Now you could say that the algorithm is flawed, right? That interest rates aren't really the primary lever here anyway. That they were too late to raise rates against inflation. People argue that they're either too soon to cut rates or too late to cut rates. All sorts of, I'm not really a fan of central bank interest rate management anyway. Right. But given the fact that that's how it's done, I mean, if you're given, unemployment rising from 3.4 to 4.3, and you have official inflation measures fall from 9 to 3%, mild rate cuts, kind of reducing the real rate makes sense. You wouldn't want a big interest rate cut before the recession. 25 basis points wouldn't be much. Jerome Powell is a registered Republican, but the majority of Fed officials tend to be Democrat leaning. But I wouldn't particularly categorize this Fed chair as particularly political. I think he's more worried about his long-term reputation. But these kind of things happen, and it's you can chalk it up to maliciousness, you can chalk it up to incompetence. But there are serious issues with the data, and I would say with the entire model of a centrally governed interest rate to begin with.
Right. And it certainly doesn't inspire confidence that we can have these kind of revisions and that these revisions are not that uncommon, as you say, and yet that this is the basis that the Fed, arguably what many have called the most powerful entity of the world, uses to make decisions based off. Given all of this, Lyn, assuming we get this cut in September, what do you project in terms of, again, immediate market reaction, immediate reaction for gold and for Bitcoin?
Right. And so going back to the prior point, one of the things I did in the book Broken Money was I was very critical of central banking in general. So they basically when the economy is going strong, they start to raise interest rates until they kind of pressure it, and then when it starts to blow up, they cut interest rates and they try to reinflate the next credit cycle. So they're kind of in theory supposed to be a counter-cyclical force, but in practice they end up being a lagging pro-cyclical force. They contribute to booms happening, and then they're unsustainable, and then they contribute to popping the booms that they themselves caused, and then they try to reflate the bust that came from the boom that they broke, right? So it's just kind of this repeated cycle of putting out fires that they themselves at least partially started. So yeah, I'm fully critical in that sense. And as far as how assets should react, I mean, basically they tend to react in a delta to what happened versus what is expected. So if the market is but as we get close, so those probabilities for what's going to happen in September will be more and more locked in. And then when the the event happens, if it's what they expected, I wouldn't expect particularly explosive asset price changes that week or that day. But if something deviates significantly from what they expected, we could see, if they cut more than expected, we'd probably see a bigger jump in gold, potentially Bitcoin, than what was priced in. So I don't specialize in these kind of multi-week or multi-month trading ranges. Right. I'm structurally bullish on gold and Bitcoin. And then when it comes to equities, it really depends on what sector, what jurisdiction of equities, what valuation. So there's some types of equities I'm quite bearish on. There's some types of equities I'm quite bullish on. And I think we're probably going to see rotations in the quarters ahead. But I wouldn't read too much into any one rate cut period.
So what are you expecting in terms of a continued rate cycle?
I think basically I would expect a kind of a gradual rate cut path unless or until we get some sort of credit event. If a credit event does not materialize of significant scale to start breaking the market in some way or get unemployment to spike above, say, 4.5%, you'd probably expect mild cuts. If you do start to get some of those events, we could start seeing 50 or 75 basis point cuts at a time. My general base case would be to see a higher low in interest rates. So for about 40 years, we saw lower highs and lower lows of interest rates, both short end and long-term interest rates. And this kind of post-pandemic hiking cycle broke that trend for the first time. We had a higher high in interest rates, both for the short end and the long end. And I think the thing we have to see next going forward, in my base case, is are we going to get a higher low in interest rates? So they could cut interest rates down to eventually 2 or 3% for the cycle, but it would still be above the zero that they held it for much of the prior decade. And should that be the case, I would generally expect that the cuts are not going to be as effective for large swaths of the economy as they normally are. And that's because generally when they hit a lower low in interest rates, there's a lot of refinancing activity among existing mortgages. Everybody can basically, kind of refinance their mortgages, and you basically get a free lunch. They just kind of refinance and lock in a long-term lower rate. And if we get a higher low in interest rates, then really the only people that it makes sense for them to refinance are the ones that originated mortgages in the past 2 years or so. And that activity was very low because of how high the rates were. So there's not a lot of refinancing activity if we get a higher low in interest rates. It would be beneficial for small businesses around the margins that generally borrow at shorter durations from banks. It could be potentially beneficial for some marginal, commercial real estate, marginal, banks that lend to commercial real estate. There would be parts of the more cyclical economy that would be, helped by those rate cuts. But the largest parts of the economy, kind of the homeowners and the investment grade corporations, a lot of that would be fairly unaffected. So I think that we could be in somewhat of a malaise for several quarters, depending on other factors. And I think that basically the market is probably over-indexing the importance of monetary policy, at least to the extent that we're in a few hundred basis points here. If they cut to zero tomorrow, then of course that would be a massive shock to the market. But right, within kind of their mandate and within this kind of base case of a high or low, I think they're fairly less impactful than maybe most market participants think.
All right. So if we have a gradual, controlled rate cut, leaving us at what, 2% by what timeline here do you anticipate?
I mean, I think I wouldn't be surprised if the rates cuts stop anywhere between 2 and 4%. It depends what inflation does. It depends what energy does. It depends on what fiscal policies happen by next year, which is partially dependent on election outcomes.
Sure. Yeah.
So I don't try to predict a specific endpoint for where this happens. There's too many variables into that, other than to say that my base case would be a higher low, which means I'd be rather surprised if we got back to zero rates in the next cycle.
Okay.
I think we're probably going to be elevated compared to that.
So the era of ZIRP, as we would call it, zero interest rate policy, you do not see coming back. And therefore you see a US economy desensitized to interest rates at between 2-3.5%. Is that correct?
Yeah, I think we're entering an era of kind of sideways choppy interest rates. And that's a problem because for 40 years, we've had higher public debt to GDP, but we've had structurally lower interest rates. And so interest expense on the public ledger has been very manageable. Same to some extent for the private sector. But as we start to go sideways in interest rates, if we kind of vary between, 2 and 6 for the foreseeable future, while public, deficits are still running at 6% of GDP outside of a recession, let alone what we would get in a recession. Public debt to GDP is still high and rising. And so interest expense is actually a really serious matter now. So they're kind of constrained on how high they could raise interest rates, especially while maintaining control of their own balance sheet. Basically the slower they are to cut rates, the sooner they might have to go back to expanding their balance sheet because eventually there's so much bonds issued and they would run out of the reverse repo facility and you get kind of a rejection by forward buyers. I think probably by the end of next year, the Fed's also going to go back to balance sheet increases. Maybe not at a very high pace, but at a positive delta. And I think that's another variable that that'll be kind of next year's story.
So the low impact on the US economy, you see that in the sense of the housing market, in the sense of businesses taking out more debt, refinancing debt. But we've had a disconnect, Lyn, from the real economy and Wall Street for quite a while now, it would seem. What would that impact then be on equity markets? Do you see that having a significant reaction to a controlled but still a lower-headed interest rate?
I think the equity market on average is too optimistic right now. They're basically assuming rate cuts, but also a strong economy. Which probably the stronger the economy is, the slower those rate cuts are going to come. In addition, it's kind of assuming that foreign capital does not decide to pull out around the margins, which is to say that right now there's a lot of global capital stuffed into U.S. equity markets. It's not really been like this since around the dot-com bubble. If you look at the MSCI World Index, 71% of it is U.S. equities, and a lot of that is unhedged, which is that a lot of foreign investors, whether it's Japan, whether it's Europe, whether it's other places, especially Asia, but multiple continents, a lot of global capital stuffed into U.S. markets, especially equity markets. And if you do start to get rate cuts, and you don't get maybe an outright crash, but you just get a softer economy, you get rate cuts, that potentially eases the dollar. And so from a foreign investor standpoint, your returns are not doing very well. You're owning equities priced in dollars and the dollar's, gone down to at least a moderate degree. You could get foreign equity holders pulling out from the U.S. markets. And so I'm a little bit less bullish on large cap, expensive U.S. equities. I'm very stock specific or sector specific. I kind of treat each individual stock separately. But for example, everybody right now when they think of U.S. markets, they think of the Magnificent Seven. Mm-hmm. But I look at stocks like Costco. I mean, Costco is an amazing company, but it's trading at 55 times earnings, right? There's really no margin of safety there. There's kind of a flight to risk off behavior, right? The whole world wants to be in U.S. large cap stocks that are either in tech or that have super stable earnings, like Costco. So there's very little appetite to be in cyclicals. There's very little appetite to be in emerging markets. There's very little appetite to be in commodities. Gold has, even though it's breaking out to all-time highs, there's very little retail interest in it at the moment. It's not really, you don't really see it on most major financial media. You don't really see any sort of mania there. It's kind of like central bank driven and Asian buying driven. You don't really see a lot of retail interest there. And so I do think that we're setting up at least a potential for significant capital rotations out of large cap U.S. low volatility equities and into other parts of the U.S. market, as well as other parts of the global market.
Which parts of the global markets do you think would benefit the most from this?
So I think that emerging markets are one of the potential areas because the way that most emerging markets work, and it's a little bit different on a per country basis, but a general rule for emerging markets is that they have a lot of dollar denominated debt. And what's unintuitive is most of that's not even owed to the U.S. The U.S. is a net debtor to the rest of the world. Some of it's owed to the U.S., but most of it is owed to Europe or Japan or China, even though it's denominated in dollars. Basically, the rest of the world runs big structural trade surpluses with the United States, and they use some of those dollars to go in and buy our equities, but they also lend those dollars to other countries, and particularly the emerging markets. And so generally speaking, whenever the dollar gets very strong, it hurts emerging markets because their liabilities are hardening. Like if you took out a mortgage in Swiss francs and then the Swiss franc doubles relative to your local currency, that's going to be a really bad investment compared to probably what your house price is doing and your cash flows, right? So that's what happens to emerging markets on a kind of a nationwide level when they have too much dollar denominated debt. So that happened in the 80s when Volcker hiked rates. It also happened in the late 90s. Where emerging markets were heavily damaged. And then to a somewhat less extreme sense, it's been happening over the past 5+ years. Really ever since 2015 or so, 2014, we've been in this kind of mildly stronger dollar period. So we've had multiple recessions in Latin America. There's been multiple currency crises in frontier markets ranging from Egypt to Ghana to Nigeria to many others. Basically, it's this kind of self-reinforcing cycle. And then nobody wants to invest in those markets because they're impaired. So they go further to U.S. markets, which then further strengthens the dollar. But we're starting to see kind of signs of that reversing. As we look forward to the Fed cutting rates, the interest rate differential is not as attractive. Many of those emerging markets have much higher real rates because they've had to. So they can start easing from even higher levels. I mean, Brazil has similar inflation levels to the United States, but interest rates that are about twice as high. So they have much higher real rates because they kind of have to have them. And so there's actually a lot more easing potential among emerging markets. And then you can start that flywheel where if the dollar eases a little bit, as it already has, some of those emerging markets start showing signs of life. And then global investors can see that and potentially allocate the marginal piece of capital to them, which then further helps their currency stabilize relative to the dollar and show more signs of life. And so capital flows actually feed on fundamentals, which then encourage more capital flows. So kind of the vicious cycle of the last 5-10 years can kind of roll over into a virtuous cycle, call it the next 5 years. And for several years, a lot of investors have been calling for potential rotation. That's kind of the big risk, is that these trends tend to go on longer than most people expect before they eventually have some sort of pivot. But a rate cutting cycle is the best catalyst for that to happen. The last time there was a big, developed to emerging market rotation was in the early 2000s. And this is kind of the next potential period. The last catalyst we had was 2019, but that was derailed by the pandemic and everything else that followed. So this is kind of the first serious catalyst in 5 years for there to be a potential rotation out of kind of crowded U.S. markets and into other markets.
If we have this rotation into emerging markets, Lyn, That is probably a good development from the BRICS perspective, especially as they are supposedly trying to de-dollarize, get away from the dollar, looking to potentially come up with their own common currency, potentially backed by commodities. You mentioned the 2000s. That's around the time where the BRICS was coined. The term was coined by Goldman Sachs. If this rotation out of US markets does go into emerging markets, what does that mean for the BRICS and I guess the bigger plot there of dethroning the dollar?
Well, so I'm a little bit more skeptical of the idea of a BRICS common currency. I think basically Europe's common currency is not very functional when you have shared monetary policy but disjointed fiscal policy. It's hard to make that work. You end up having basically the central bank trying to support Italy's debt problem while not supporting Germany because they have more austerity, and it's kind of like you start to get polarization and kind of issues in that market. A lot of the BRICS countries don't actually like each other that much. China and China and India have tensions. Now Egypt, and Ethiopia are both in BRICS, and they have conflicts over a dam on the Nile. There's multiple entities in the BRICS that are on cold to lukewarm terms with each other. Some friendlier than others. So they have less in common than the European countries. And so I think that's my focus there is more on that they're increasing their bilateral trade. They're increasing their ability to do trade without relying on dollars. And they have both the leading world's manufacturer in China, multiple commodity producers ranging from Brazil to the Middle East to Russia. They have multiple commodity producers. They've got the Suez Canal. They've got multiple kind of important pieces to having a fairly strong circular economy. Especially they can still add more. And so I'm fairly bullish on the economic prospects of the BRICS. But there's been a lot of false starts with claims around a shared currency. Even if they announce one, then it becomes okay. They're actually going to implement it. And if they do implement it, is it going to be something they actually use domestically, or is it just going to be kind of a reserve currency that they use for bilateral trade? Maybe that's a possibility. So I think that my main focus on them is whatever tools they end up using, whether it's bilateral trade agreements or even some sort of international unit. I think most of it would be for facilitating international trade without going through the dollar-based system. And I'm fairly bullish on them figuring out multiple ways to make that increase over time.
Okay, but in terms of what it means for the dollar in the long run, if they are moving away from the dollar and using their own currencies, if perhaps not a common currency, combined with this idea that you said that the biggest, focus or threat for the US is fiscal dominance and how that's negating the impact of monetary policy and the Fed and of course the US debt level at the level of it there, and it's at exceeding well over $35 trillion as we speak. How does that fit into your longer term outlook for the dollar, for a potential sovereign debt crisis, which many of our guests seem to think is relatively imminent? Where do you see all of that fitting in?
So I think long term, it's bearish for the dollar, and it will cause the Fed to have to buy more of the Treasury market than they have before. So more self-financing. I don't particularly think it'll be imminent. I think this will be a very long train to run. I think multiple years process. Basically, I think we're headed toward a more multipolar world, which means a more spread out distribution of reserve assets, so less concentrated in the dollar. One of the things that a lot of people underestimate is the power of network effects, right? So the U.S. has, if you're the biggest, most liquid currency, it's very hard to dethrone that. It's not impossible, but it's just very hard. And then it's not just about the currency; it's about what you take the currency to invest in. Right. So with the U.S. market, you have the biggest, most liquid capital market in the world, between equities and corporate bonds and treasuries and private equity and real estate. There's the very big ocean of assets to buy with dollars. And then they can even be used to buy other, foreign assets, basically all that emerging market dollar financing we just talked about. Whereas, there's been issues with the BRICS so far where, for example, Russia will run a surplus against India. They'll accumulate a lot of rupees, and then they'll say, well, we don't really want this many rupees. What can we do with so many rupees? Because they don't have the depth of the capital market that the US has. And so when you have a lot of those bilateral trade things, it doesn't quite flow as smoothly. And that's a solvable problem over time, but I think it'll take a while. I think in general, we're going to see gold continue to probably increase its market share among central bank holdings. If you can buy a currency that the dollar, the broad money supply historically grows at about 7% per year over the long run. Gold grows at generally less than 2% per year in supply over the long run. And so as long as you're getting something like less than a 5% yield on your dollars, you're probably in the long term losing out to gold. And basically, given how indebted the U.S. government is, it's very hard to run positive real rates for any significant period of time, especially relative to money supply growth, not just CPI. So I think we're probably going to see ongoing central bank, reserve diversification. Some of it will be in the gold, and some of it will be around the margins into their trading partners. So rather than holding zero of a given country's currency, they might hold 1 or 2 or 3 or 5% of their reserve holdings in a given other country's currency. And so the net effect of that, I think, is a more multipolar world where the US is still a big currency, it's still a big market, but it's not so over dominant that it has been. I think that's probably the trajectory that we're headed to. And even sovereign debt crisis can take quite a while. I mean, it's like asking how long has Argentina had inflation for? Or how long has, you can kind of name an emerging market. And a lot of times you have these long drawn out currency issues, long drawn out periods of turmoil. And the United States, I think, is going to go through a fairly long period of very large structural deficits that at times are monetized by their own central bank, even during periods where potentially inflation is above its official target, the way they measure it. They could try to change the measurements. They could try to change the narrative for where that inflation is coming from. They can say it's coming from price gouging corporations. It's coming from, if we get an oil price spike, they can say, oh, look, it's OPEC is doing it. You can kind of direct the blame around. But basically, I think we're in just a higher period of background, kind of structural, fiscal driven money supply growth. And I think it's going to be a long-term story before it turns into something more acute, even though the consequences start to materialize, that they've already been materializing in many ways.
All right. So still quite a long runway before these sovereign debt crises and their consequences come home to roost. Let's focus on the idea that the U.S. is in a state of fiscal dominance, where the government's large debts and deficits dull the impact of monetary policy. As you say, this has led to higher average inflation, shallower business cycles, and a potential slow motion fiscal spiral. Break that down for us. Explain what this means.
Yeah, so there's a couple different ways to break it down. One is what I mentioned before, that we had 40 years of ever rising debt to GDP and ever falling interest rates. And so interest expense was manageable for 40 years. That's why a lot of people were very early. The national debt clock went up in the late 80s. And Ross Perot ran one of the most successful independent presidential campaigns in the early 90s. That kind of late 80s, early 90s period was like the peak zeitgeist for the debt being a problem. And if you look at interest expense as a share of GDP, it was very high back then. But what they didn't necessarily anticipate is that China would open up to the world. And then the Soviet Union would open up to the world. And you'd have this big disinflationary 30-year period of globalization that followed. And so we had all this kind of efficiencies coming together. They were able to reduce interest rates for 40 years from the early 80s all the way down to the 2020 I mean. Basically, and so that was a big offset for the rising debt to GDP. But when you start to go sideways in interest rates and even sideways to up, as we have lately, that starts to actually really blow out interest expense for the first time. And there's really no offsets for that anymore. It's a demographics problem. It's both an entitlement problem, the way it was structured. It's a problem related to just decades of how we've done military spending and what we've gotten from it, if anything. Basically, multiple kind of decades of fiscal levers have kind of driven up to this level. And so that's the one thing, that's the one big change, that we're no longer falling in interest rates. Even if we're not rising, if we're just going sideways in interest rates, that's a new variable that actually starts to make interest expense be a really big deal. The second factor to quantify is that, for most of the past 70 years, in the data sets that are available, and even further than that, when you go back, basically until you get back to World War II, bank lending is a bigger, kind of a number each year. Like the amount of net new bank loans created is a bigger number than the annual fiscal deficit in most years. The only generally exceptions are brief periods of time, during or shortly after recessions. And what we've encountered in the modern era is that, generally speaking, deficits are bigger than the amount of new bank loans created in a given year, and then even bigger than the sum of new bank loans and net new corporate bond issuance. And so that the fiscal deficit issuance is now just quantifiably a much bigger number. And so that impacts markets more than just the credit cycle. Basically, instead of kind of the credit cycle leading, the credit cycle is just one of two really big components, and that fiscal side is less cyclical. It's just always kind of pouring out more money. And the third way to think about it is, a lot of the wealth is held by not just the wealthy, but also the upper middle class, right? And so you can imagine a homeowner in their 50s or 60s, and they've got a locked-in fixed-rate mortgage, and they've got a lot of money markets. Every time the Fed raises interest rates, they actually give them a raise because their interest expense is locked in, and now they're earning more money that's spendable on their money market funds or their treasuries in general. And the same is true for cash-rich companies like Google, right? Or Alphabet. They have fairly low debt. They have a very high amount of cash equivalents in the form of T-bills and other instruments. And every time the Fed raises rates, they're trying to slow down the economy, but they're giving Alphabet a raise. They're giving an upper middle class family a raise. And so when the Fed raises interest rates at a time when bank lending is the primary driver of money supply growth, and deficit and public debt is low, that tends to have the disinflationary effect that they intend. But when you have 130% debt to GDP, and you raise interest rates when bank lending is not very elevated, you end up being somewhat counterintuitively stimulating certain parts of the economy. So it is slowing down commercial real estate. It is slowing down small businesses. It is slowing down, junk-rated corporations. But it's ironically somewhat stimulating cash-rich corporations and somewhat stimulating, the financial system as a whole, especially ones that are well positioned for it, and stimulating the upper third of consumers. And so monetary policy becomes less effective when public debt to GDP is at these types of levels.
Does it matter then who wins the elections? I don't see either party really reducing spending, although if we're to understand what we're hearing from the Democrats to control price gouging, there could be price controls, there could be capital gains taxes. Again, this would, of course, not just mean on presidential elections. It would have to have Democratic control of the House and the Senate. But does the election and its outcome potentially impact this one way or another?
So I view the fiscal side as something like 80% locked in. The other 20% can change based on elections and based on other variables. But I think the vast majority of it is locked in, which is to say that regardless of how the election turns out, you're probably not going to get a filibuster-proof majority, right, in the Senate. So either way, we're going to have a somewhat polarized environment. This is a historically polarized environment that's projected to continue. So whether even if you get all parts slightly lean blue or all parts slightly lean red, you still can't necessarily get the really big ticket changes through because you're up against filibusters and things like that. And so generally things like unrealized capital gains, I'd be skeptical. I would assign a low probability of them getting through. It doesn't mean that they shouldn't be analyzed and taken seriously, and that the market's going to price different kind of election outcomes accordingly. But around the margins, a lot of this is locked in. One of the notable changes is that the Republican Party used to be in favor of around the margins, trimming Social Security, privatizing Social Security, doing other things like that. That was kind of the Paul Ryan era of the Republican Party. Whereas in the current 2024 Republican platform, they promised not to touch Social Security. That used to be a Democrat position. So one of the few things that the parties agree on is basically don't cut the big drivers of spending. There's not really a lot of appetite to cut military spending. There's just some appetite of
Right.
where it goes. There's not a lot of appetite. There's virtually no appetite to cut Social Security. There's very little appetite to cut Medicare, except for a little bit around the margins for certain medicine pricing and kind of that kind of area, but nothing structural. The Democrats are in favor of raising taxes, which unless you get a pretty sweeping win, seems somewhat unlikely. There are some tax cuts that were done under the Trump administration that are set to expire in 2025. They're not huge around the margins, but they are meaningful. And so I think that's one of the levers that is probably relevant based on the election outcome. That's kind of locked in unless you get certain outcomes. So it's not that the election doesn't matter fiscally. It's just that I think many investors maybe over-index to how much that matters compared to how much is accumulated over the past several decades and then pretty much locked in politically, especially because the voter base is the ones that generally receive Social Security and Medicare, and there's really little appetite to cut the military. So I think a lot of it's locked in.
Okay, so fiscal dominance locked in more or less regardless of who wins the election. You're ultimately seeing a controlled rate cut, but that the economy will be largely desensitized to it in terms of real terms. Let's talk about what this means, though, for investors. In your newsletter, you mentioned the 3-pillar portfolio strategy: stocks for disinflationary growth, cash bonds protection against liquidity contractions, and commodities, hard assets protection against inflation and currency debasement. Break that down for us. And let's start off with the commodities, grouping gold and Bitcoin into that category.
Yeah, that gives a portfolio inflation protection. And so it actually helps to kind of clarify what the 60/40 portfolio does first, which is to say that the classic 60/40 portfolio, especially one that's just inherently U.S. equities and then U.S. bonds, that's a portfolio that's very weighted toward disinflation, right? So it generally, stocks benefit from disinflationary growth, and then bonds benefit from disinflationary recessions and things like that. Whereas the decades where both stocks and bonds do rather poorly, especially in real terms and sometimes in nominally terms, is when you have decades of inflation. So whether you look at the 1910s, the 1940s, the 1970s, or the 2000s, those were kind of the four inflationary decades of the modern era. All of those were ones where a combined stock and bond portfolio was not a particularly good one in real terms. And what did do well was that third component, which is some combination of commodities, commodity producers, especially energy producers, ideally gold, kind of hard money. In the modern era, that can include Bitcoin. Basically having that kind of that more inflationary protection side holds up pretty well in those decades where specifically stocks and bonds don't do particularly well in real terms. And the challenge is that, when you look at that kind of commodity side on its own, it's not historically a great performer. They during decades where stocks are doing amazing, that other side is generally languishing. I mean, if you look at the performance of oil or gold over the past 10 years, or energy producers or the commodity sector as a whole, not very strong. But during those decades where it actually does well, it kind of saves a portfolio. So when you actually incorporate that into a broader portfolio, it really improves kind of the long run risk-adjusted returns. The 60/40 portfolio became popular specifically in this 40-year window of ever falling interest rates. It's only really back-tested that far. Whereas when you actually include a longer term period and you take into account those inflationary decades that tend to come fairly reliably based on the commodity capex cycle and other matters, I basically argue that it's useful to not have a 60/40 portfolio and to instead have at least some gearing in the portfolio toward those inflationary assets.
And of course, you group Bitcoin in that category?
Yeah, I think it's basically we don't have obviously the long-term track record of those other decades like we do with gold or with energy, but it fulfills a similar purpose, which is that it's money with a finite supply. There's some disadvantages relative to gold that it's got a shorter track record. It's a different type of money, but it's got some advantages, which is that it's globally portable. Much easier than gold. It's got a lower supply inflation rate than gold, and I would say it's still below its total addressable market. So it's still held by very kind of a small percentage of people in any meaningful capacity. And so I think now Bitcoin is in that bucket of probably harder assets you want to hold if you expect ongoing currency debasement. If you expect positive real rates for foreseeable future, and you expect good equity growth, then that's kind of a case to just, you can own equities, you can own, those types of assets. But if you do expect long-term currency debasement and kind of, risks from all this kind of policy materializing, that's where assets like gold and Bitcoin and things like energy producers can come in really handy for a portfolio.
So, Lyn, last time you and I met in person was sadly October of last year, I believe, and Bitcoin was around 35,000, give or take, when we last chatted. Since then, we've seen Bitcoin hit new all-time highs. It's trading at around, I think, 62,000 more or less today. But we've also seen a significant development in that we have presidential candidates talking about Bitcoin, making it a political issue on both sides of the aisle. We've seen conversations about making Bitcoin part of some kind of strategic reserve. I mean, that is, if you take a step back, that is a phenomenal development in less than a year or so. Where do you see Bitcoin then in the next 12 months?
So generally speaking, in the next 12 to 18 months, I'm fairly bullish on it. Generally speaking, the biggest correlation I found to Bitcoin price is global liquidity. And there's multiple ways to measure global liquidity. The one I tend to use is global broad money supply denominated in dollars. And so there's both a credit creation component and a dollar index component to that liquidity measurement, which is relevant because of how much dollar-denominated debt exists in the world. And generally speaking, when that's doing well over a given 6-month period, normally Bitcoin's doing well over a given 6-month period or 12-month period. And when that's doing poorly, usually Bitcoin's not doing great either. That can't really tell you what's going to happen on a given week or even a given quarter. But over a 12-month period, if you have a high conviction on the direction of global liquidity, generally speaking, Bitcoin is a good way to express that, especially if you look at other Bitcoin-specific indicators. So if you look at, for example, the market capitalization of Bitcoin relative to the realized capitalization of Bitcoin, which is another way of saying the on-chain cost basis of Bitcoin. So every coin price at the last time it moved on-chain in dollar terms. You can look at the multiple between market cap and then the cost basis during those really big like bull market tops that generally have like a 3-year correction after them. Usually you get a very high gap between market cap and realized cap. So far, we've not really hit any of those extremes in this cycle. In addition, whenever you have a really strong bull market, you do generally get selling from longer term holders. Someone bought Bitcoin 5 years ago and they might be up 5x in their position. Maybe they want to buy a house and start a family, or maybe they just want to diversify to some extent. Maybe Bitcoin's now like 90% of their net worth and they want to trim it back down. You start to see selling pressure from those longer term holders that are significantly up in their price action, and that kind of exhausts some of the incoming demand eventually. That's kind of what contributes to the bull market's ending, along with liquidity rolling over. And so far in this cycle, there's only been kind of a modest amount of that longer term selling. So I don't really consider that this cycle has hit any of the extremes of prior cycles. And so the combination of being pretty positive on liquidity for call it the next 18 months and not really seeing too much excesses in the Bitcoin space currently, my base case is bullish on Bitcoin over the next 18 months.
How bullish?
I mean, I'd
Do
be
you?
surprised. I'd be surprised if we don't hit six figures in this cycle. Whether it's 18 months, if I give myself some extra room and say 24 months, I'd be surprised if we don't hit six figures. We could go way north of that. Like we could, I wouldn't find it inconceivable to go well into the six figures, but I try to have conservative estimates. And I would say that generally speaking, if we're having a conversation 2 years from now and we've still not seen 100K, despite having a positive liquidity cycle, I'd be surprised. If something happens to impair the liquidity cycle, like let's say some war breaks out and the dollar index spikes to 110, or if you get an event like that, kind of like how in 2019 anyone predicting that what was going to happen next year would have been blindsided by COVID. So if you get something like that that prevents global liquidity from going up like I expect it to, that would not surprise me to see Bitcoin have a rough time. But I would be surprised not to see Bitcoin notably north of here if we do have another 18 months of rising liquidity.
Okay, so Bitcoin at 100,000, and we'll give you a grace period of 20 months if the global liquidity train continues. But you're saying that a potentially big geopolitical event may impact, well, not so much global liquidity, but dollar strength.
Well, dollar strength is pretty much by definition a really bad liquidity event because there's so much dollar-denominated debt. And so what that represents is basically the unit of account of liabilities increasing sharply, right? So that's almost by definition a negative liquidity event, especially the way that I define it, which is global broad money supply denominated in dollars. So whether you look at it practically or however you define that metric, a very sharp and strong upward move in the dollar is generally bad for liquidity. So you would generally not expect, even gold might not do very well in that environment, but gold would probably hold up better than Bitcoin. Bitcoin and most fairly volatile assets would probably suffer in that kind of dollar spike. And that could be war related. That could be a big credit event in some pocket that no one's really looking at the moment. Usually these things emerge from not whatever people are focusing on.
Mm-hmm.
So, that's kind of if I would imagine how I'm wrong, like if I picture, okay, my base case is Bitcoin going to see 100K. If I think, okay, what are the things that happened if I'm wrong? Well, one is, that basically we did not get that liquidity as expected. We got a big dollar spike, or we got some sort of, geopolitical event related to energy or related to war or something. Or some sort of big crackdown on Bitcoin, something like that would be reasons why Bitcoin doesn't hit 100K. Is basically that my base case ends up being incorrect.
Lyn, if Bitcoin is supposed to be a safe haven or store of value asset, and it doesn't do well in a period of geopolitical upheaval, does that negate the case for it being a safe haven?
So I don't define it as a safe haven asset per se because most people don't understand how it works. Most people can't tell you what the halving is. Most people can't tell you how the 21 million code is enforced. Most people can't tell you what the block size limit is or what the block time is. It's not a very well understood asset yet, despite the fact that it's 15 years in. Now, the aspects where it's a safe haven asset is that if you self-custody Bitcoin, regardless of what its price is doing, if price could go up or down by 20, 30%, fairly short, but you have global capital that you can bring with you anywhere. But you could memorize 12 words, right, representing your private key, and you could bring your money and almost anywhere in the world where you can eventually reconstruct it with any sort of internet access at all. So that's the safe haven element to it. But because it's still an emerging one, it's still an emerging store of value. It's more volatile than something that's already reached its total addressable market because it's kind of priced like an option. It's priced on the probability that it's going to reach somewhere closer to its total addressable market, which I think is well north of here. And so because it's priced like an option, it has that issue. So I would describe it as it's mostly a liquidity correlate. And so if there's a risk-off event or some sort of crisis event, it depends on whether that crisis is pro-liquidity or negative liquidity. Most crises are bad for liquidity, but there are some that are good for liquidity. So for example, the March 2023 regional bank crisis was actually good for liquidity because the Fed and the Treasury had to pretty much step in that weekend. So actually the week leading up to that was fairly bad for liquidity, and Bitcoin was not performing well in the run up to that banking crisis. But as soon as that banking crisis materialized, within a couple hours, Bitcoin was actually doing quite well because the whole market was pricing in, kind of a partial Fed pivot, a Treasury pivot, and so Bitcoin actually did pretty well when the U.S. banking system was running into stability issues. But on the other hand, if you get like a geopolitical event and dollar index spikes from, 101 to 103 or 104 or something like that, that's generally an anti-liquidity crisis, and Bitcoin usually does not do very well, at least in the near term. So, for example, when we had the yen carry trade hiccup in the markets a few weeks back, Bitcoin had a really bad 24 hours. It already rebounded back to what it was before that event. But as one of the only sources of liquidity on a Sunday night, it was sold because it could be. So on the one hand, it kind of served its purpose as a safe haven asset, that if you were holding Bitcoin, you had access to liquidity on a Sunday night, and it's the most liquid version of that. Technically the other cryptocurrencies do too, but they're much lower liquidity, they're much less secure. So you have the most liquidity on a Sunday night. But the downside is if you're just kind of holding through that, you can take a 15% price haircut overnight, which, if you have spare capital available, you can use as a buying opportunity. But I think that basically it's on its way to being a safe haven asset, but it's still small and still kind of dispersely held and still something that's kind of being explored.
So yeah, it depends, I guess, on your immediate definition of safe haven.
Yeah.
Lyn, as we're running out of time here, does it make a difference to you regarding Bitcoin, how the elections play out?
I think, yeah, around the margins. I think that's one of the areas where the election is pretty material, because it's interesting. There's a recent study by Troy Cross and others that showed that if you actually survey people that hold Bitcoin versus people that don't hold Bitcoin in the United States, there's actually very little difference between those groups. Like, there's not really a big political skew, as you might expect. There's not really a big education difference between those groups. The main difference is that the Bitcoin group tends to lean more male and tends to lean younger. But other than that, there's not really a big political divide among Bitcoin holders versus non-holders. But among politicians, we have seen a pretty clear trend that the Republican Party is more supportive of Bitcoin than the Democratic Party, and at least this current administration, and potentially the successor administration. Now, during the Bitcoin conference, even though the headline was Trump and other predominantly Republican lawmakers, there were some Democratic lawmakers there, including Ro Khanna. And during the event, over a dozen Democrat representatives wrote to the DNC saying that their party has to be more supportive of this industry. So the way I kind of described is that you got something like a majority of Republicans in favor of it, something like a minority of Democrats in favor of it. And so you've kind of got you're protected from a supermajority against Bitcoin. But whether you get a Republican administration or a Democratic administration probably matters a lot for the SEC. So probably matters a lot for broad crypto, more so than just Bitcoin, because that gets down to how crypto securities are regulated. So that's a factor. And then two, whether there's serious efforts to try to build a Bitcoin reserve, or let Bitcoin mining flourish, or keep kind of putting pressure on it. There's different things around the margins that if you do work in the industry, it's I think a pretty big deal. There's also the Department of Justice and the Treasury, can kind of go after privacy techniques. People that want to be private with their money. There's kind of more aggressive enforcement that can be done, or less aggressive enforcement that can be done, depending on who's in charge. And actually, during the prior Trump administration, he was anti-Bitcoin at the time, and so the Mnuchin Treasury was not good for Bitcoin privacy. Now that seems to have shifted, based on Trump's pivot on the issue. So we probably should expect less aggressive enforcement should you get that Trump administration versus, say, a Harris administration, at least around the margin. So I do think the election outcome is probably meaningful for that specific set of industries.
All right. So we are headed into a rate cut cycle, which is not going to be that impactful On the real economy, we'll see how the markets react, but ultimately it's all about a question of global liquidity and fiscal dominance. And in terms of assets most impacted by the election, Bitcoin is top of that list, if I may summarize that last sentiment.
Yep, I think so.
All right. Final thoughts here, Lyn, as we wrap up.
I think that this is a rapidly evolving, market environment. The last 5 years in general have been a lot of big whipsaws in multiple directions. And so, there's one thing to have outlooks. We all try to have outlooks. And so the way that I frame it is we set a base case, we have historical precedents, we have kind of expectations of what's likely to happen. But then it's important to monitor things month by month, quarter by quarter, and actually see what's materializing, what's not materializing, how does a thesis have to change. And so that's generally the two timeframes that I try to operate on. Have a structural view, but then be open to being flexible and pivoting to basically see what is actually materializing. Is a thesis being validated or invalidated? If so, why? And if so, on what timeline and how to respond? So it pays to be diversified. It pays to be open-minded. And this is, it's a challenging and interesting market environment.
And it pays to listen to Lyn Alden. Lyn, always great having you on the show. Thank you so much. Really appreciate it.
Thanks for having me.
Thanks again, Lyn. Thank you, as always, to you for watching. And a big thanks to our sponsor, Swan Bitcoin. I do want to highlight that Swan has an IRA product where you can take advantage of the benefits of Bitcoin's long-term potential in a tax-advantaged account. And with a Swan IRA, you're holding real Bitcoin, not proxies. And opening a Swan IRA is actually very simple. You can initiate a transfer or a rollover, and then you're holding real Bitcoin in your new IRA. And there's a way to set it up so that you're basically buying Bitcoin on autopilot. And that then allows you to take advantage of dollar cost averaging and those often volatile Bitcoin price moves as you accumulate Bitcoin into your IRA. Now, remember, unlike when you're trading Bitcoin outside of a tax-advantaged account, doing so within an IRA does allow you to avoid the often rather tedious process of reporting trades on your taxes each year. So there is a link in the description with a special offer for Kitco viewers to help you facilitate that process. The description at the bottom of this video. Make sure to check that out. Thank you again for checking us out. If you are watching us on YouTube, please make sure to subscribe and leave your comments. Feel free to praise, whine, or just opine. For me, Michelle Makori, and the rest of the Kitco team, we'll see you again soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Bitcoin IRA. Your legacy, your way. Real Bitcoin, not proxies. Traditional and Roth IRAs. Fast, easy setup. Start now at swan.com/retire.